Our sense is that September is the center of the central scenario for us, but maybe if anything, given the slight tick up in inflation in recent times and the resilience of the economy, the risks are maybe it is further out rather than is brought forward to this week.
And you're paying attention to 5 to 7 year maturity profile in the U.S. dollar bonds here. So eventually you see the yields coming off a little.
Yeah, so if we look at our view in the 10-year yield towards the end of the year and in the beginning of next year, we're looking at the 10-year yield being around 4 to 4.25%. So obviously not materially lower than what we are today, but we are suggesting that we could see a short-term spike in yields, but anything above 4.5, 4.6% on the 10-year is a good opportunity to be averaging into high-yield bonds, high-quality bonds. Obviously, as you mentioned, this 5 to 7 year, I think that's the best balance of the risks because inflation is expected to tick higher. We still have some fiscal concerns out there, so maybe that's the best place to take a balanced approach to the yield on offer, but also the risk of short-term drawdowns.
Yeah, we had a guest on earlier this morning talking about Japan fixed income side and said the election outcome was overrated, that it's been already priced in here, doesn't really change the outcome of a fiscal loosening. Do you agree with that line? Is there anything exciting or new that's not priced in to work with?
I guess the only thing it does is it just increases a bit of uncertainty because obviously it makes the policy decision-making process more complicated. And that comes at a time when obviously yields are in an upward trend in Japan, and there's a lot of conversations around whether that's a leading indicator of what happens around the globe. But for Japan, obviously it is an important feature. We're kicking up towards the high on the 10-year yield already. So I think from that perspective, I don't think it makes that much of a difference actually from the outcome of macro policy, but it may increase policy uncertainty as we go through.
While people are asking questions around, what's happening in the U.S., it's like meme stocks are back, and does that show signs of overheating and so on? So let's go there first. So do you see any signs of overheating? I know that you are long-term bullish when it comes to U.S. equities, but short-term?
Yeah, so there are some signs of overheating. In fact, one of the reasons we turned very bullish in equities on April 11th was extreme short positioning or underweight positioning in US equities at the time. Obviously, that was post the April 2nd announcement. So that's when we sort of felt that adding risk back was a really good opportunity. That underweight position has now normalized. We're actually marginally overweight, not at extreme levels, but it does show that there's a little bit of signs that market confidence is coming back. You have obviously the meme stocks is another sign of that. But I guess our challenge is it's not gangbusters bullish. There's still a lot of cautious commentary out there, which means of course markets can melt up in the short term, but we're seeing some risks on the next 1 to 2 months basis. So let's not chase the market today.
And when that happens, at least a short-term correction or some kind of adjustment in portfolios, do you see some parts of Asia getting damaged as well? I'm paying attention to this huge upside for Hong Kong and South Korea.
Yeah, so obviously, if we do see a risk-off environment, that will probably extend to the emerging world as well, including Asia. I think the other point is one of the things that investors are significantly underweight, both in terms of narrative but also positioning, is the US dollar. So if we did see a US dollar bounce, that might hit Asia equities more severely than US equities for a short period of time. But we think the dollar has made a major peak and is likely to weaken significantly. From if we do see getting up to 99 or 101 on a dollar index, then we'd be selling that dollar rally, and then that would be a great time to be lightening up on your US exposure and investing into an overweight allocation to Asian equities.